William Lively did not build his reputation by predicting trends. He built it by solving problems most investors and technologists preferred to work around. In private markets, especially commercial real estate, those problems are structural: fragmented data, manual workflows, opaque reporting, and decision-making that struggles to keep pace with scale. Lively's career has been defined by a single, disciplined idea. If you fix the infrastructure, everything built on top of it improves. That idea led him to found Extrance, a company that quietly became essential infrastructure for institutional investors navigating increasingly complex portfolios. The platform's acquisition by a global investment bank cemented Lively's standing as an operator who not only understands AI and machine learning, but knows how to deploy them inside regulated, high-stakes capital markets. This is not a story about hype cycles or consumer fintech theatrics. It is about execution in environments where mistakes are expensive and credibility is earned slowly. Before Extrance, Lively worked at the intersection of finance, technology, and alternative investments, including co-founding SynthEX Labs and advising blockchain-focused ventures through DCI Capital Advisors. These roles exposed him to a recurring pattern. Private equity and real asset investors were sitting on enormous volumes of data, but very little of it was structured for intelligent analysis. Reporting lagged reality. Insights arrived late. Risk was managed reactively rather than predictively. Lively did not see this as a tooling problem. He saw it as an architectural failure. Extrance was designed to function as a data and intelligence layer for private markets. By integrating machine learning models, AI-driven analytics, and blockchain-based data integrity, the platform allowed investors and sponsors to manage assets with a level of clarity typically reserved for public markets. The goal was not automation for its own sake, but decision quality at scale. That focus immediately differentiated the company. While others chased visibility, Extrance built trust with institutions that demanded reliability, auditability, and depth. One of Lively's defining choices was resisting the temptation to overpromise. Extrance did not market itself as disruptive in the abstract. It addressed concrete inefficiencies: manual data reconciliation, inconsistent reporting standards, and limited forward-looking analytics. AI was not positioned as a magic layer, but as a practical tool for forecasting performance, identifying risk signals, and improving capital allocation decisions. Internally, this translated into a culture of disciplined experimentation. Teams were encouraged to prototype aggressively, but every idea was stress-tested against three criteria: customer value, scalability, and regulatory feasibility. Creativity was welcome, but only when paired with accountability. This approach produced one of Extrance's most important innovations: a modular development architecture that allowed institutional clients to customize workflows without fragmenting the core platform. It reduced implementation friction, improved retention, and ultimately became a material factor during acquisition discussions. For Lively, innovation without durability is noise. Infrastructure, once trusted, compounds. Lively's leadership style reflects the environments he operates in. Private equity and institutional finance do not reward improvisation disguised as vision. They reward clarity, process, and judgment under pressure. At Extrance, Lively emphasized what he describes as triangulated decision-making. Data provided the baseline, intuition tested edge cases, and dialogue exposed blind spots. Major platform decisions were rarely made in isolation. He sought out dissenting perspectives, particularly from those closest to the technical and operational realities. This discipline mattered most during high-stakes moments. When clients pushed for accelerated features, or when market volatility raised questions about roadmap priorities, the company avoided reactive pivots. Transparency, early communication, and shared problem-solving became default behaviors. The delegation followed a similar logic. Lively focused his time on vision, investor relationships, and existential decisions, while empowering leaders across engineering, product, and operations to own execution. The result was an organization capable of scaling without centralizing every decision at the top. The acquisition of Extrance was less a surprise than a confirmation. Large financial institutions have long understood that private markets cannot scale efficiently on legacy systems. What they lacked was infrastructure robust enough to integrate with existing processes while enabling advanced analytics and automation. Extrans fit that need precisely. Its technology was not experimental. It was production tested in demanding institutional environments. The acquisition validated Lively's belief that AI and machine learning deliver the most value when embedded deep inside operational systems, not layered superficially on top. During the transition, Lively approached integration as a design problem rather than a corporate exercise. Preserving the innovative culture while accelerating development inside a larger organization required intentional leadership. The emphasis remained on product continuity, client confidence, and long-term platform evolution. For Lively, the exit was not an endpoint. It was proof that infrastructure-first thinking still wins in capital markets. Since the acquisition, Lively has remained deeply engaged in conversations shaping the future of AI-driven investing. He is particularly focused on the convergence of predictive analytics and blockchain-based smart contracts. In his view, the next phase of private markets will be defined by systems that do not merely analyze data, but execute decisions with embedded trust and transparency. This perspective positions him squarely in ongoing debates about AI governance, data integrity, and the modernization of private equity operations. His credibility comes from having built and exited a company in this space, not from theorizing at a distance. Lively is candid about the challenges ahead. Regulatory complexity, legacy workflows, and cultural resistance remain significant barriers. Fintech moves at the speed of code, while real assets operate on decades-old frameworks. Bridging that gap requires more than technical skill. It demands patience, collaboration with regulators, and a deep understanding of institutional incentives. Many executives struggle to remain relevant after a successful exit. Lively has taken a different approach. He continues to invest time in learning, advisory roles, and strategic conversations that sharpen his understanding of where AI and private markets are heading. He studies emerging models, participates in closed-door industry forums, and remains closely connected to operators navigating similar challenges. This keeps his thinking grounded in practice rather than abstraction. Lively is also open about what he would change if starting again. He would invest earlier in scalable systems and leadership depth. Wearing too many hats in the early stages provided insight, but limited velocity. The lesson, he says, is that sustained advantage comes from building teams that can outthink and out-execute the market. While Lively's work now spans investing, technology, and philanthropy, the throughline remains consistent. Identify structural gaps. Build trust through execution. Measure success by long-term impact rather than short-term visibility. His involvement in social impact initiatives does not dilute his relevance in AI and private equity. If anything, it reflects the same systems-oriented mindset. Whether building fintech infrastructure or expanding access to technology, the work is grounded in architecture, not optics. William Lively's career offers a counterpoint to the dominant narratives in AI and fintech. Progress does not always arrive loudly. Sometimes it arrives through platforms that quietly become indispensable. Extrans was one of those platforms. Its success was the result of disciplined leadership, technical fluency, and an unwavering focus on infrastructure. In private markets, where complexity is the norm and trust is the currency, that combination remains rare. And it is precisely why William Lively continues to matter in the conversation about where AI, machine learning, and institutional investing are headed next.